Thank you all for joining us tonight. I have some good information to share with you all tonight. Hello, A1 Stylist. How are you? Thank you for joining us tonight. Just waiting a few minutes. Well, not a few minutes, but just waiting a few seconds to let some more people log in. Hello, how are you all? Hey, Kiana. So, if this is your first time joining the sessions, I've been on every Tuesday this month with Brownstone, giving you all the Brownstone experience. So, if this is your first session, just know if you see me going from side to side, that's because I'm on two different devices. I'm on live stream on Instagram and Facebook at the same time. So we can make sure as many people as possible get this awesome information. So as you can see in the title of the session, we're going to be talking about investing tonight, which is a really big topic. I get a lot of questions from people about investing because this is something that everybody wants to know about, and it's a way that we can build generational wealth and experience financial freedom. So this is a really huge part of our financial planning and saving for retirement as well. Hello, ladies. Thank you for joining us tonight. So it's actually 6:01 p.m. and you know I am a stickler for being on time. So I want to go ahead and get started. Thank you all again for joining us tonight. And again, I just want to mention for those of you who this may be your first time joining us tonight, just let you know if you see me going from side to side, it's because I'm on two different platforms. We're on Instagram and also Facebook right now. So tonight I want to give you like an overview, introduction to investing, and basically kind of like a basics to investing. So this information that I'll be sharing with you tonight is some information that's really important and vital to know before you even start investing, because you want to make sure you have a good understanding and a good foundation about investing before you get into it. I know a lot of people invest in their employers' retirement plans, and they have absolutely no clue what they're investing in. They just put their money in there. But I want you to be able to have a better understanding of what you're investing in, and even as you're looking into other ways to invest, I want to be able to share some information with you on that as well. So let's get into it, because I have a lot of information to cover tonight. So tonight we're going to be talking about different types. I'm going to talk about different types of assets, and we're going to talk about cash flow and how to distinguish the different types of cash flow, and explain to you about return on investment, and also help you to understand how to determine what your net worth is and your ability to achieve financial freedom. So some big takeaways tonight is I want you to understand that there are different types of investments, and there is a specialized vocabulary when it comes to investing. So just let me explain. With finance, period, there's a specialized vocabulary, because you can hear two different words and they both mean the same thing. Like, for instance, you may hear the word yield and you may hear the word interest. Same thing. So just getting a good understanding of the different types of terms and vocabulary words that are used in finance and investing really helps to have a good understanding. There's also some tools and some different types of formulas to calculate the different costs associated with investing, and also how to calculate your return on investing on the things that you're investing in. And also, there are many considerations when you're evaluating your different types of options when it comes to investing. So basically, the purpose of investing is to achieve financial freedom, right? To be able to live the life that you want to live without any financial worries or stress. People invest so they can live the lifestyle that they desire without those worries about how you're going to pay your bills, making ends meet. And basically, financial freedom means that you will be able to retire and spend time doing the things that you really love and enjoy. And to become financially free is very important because you want to make sure that you get your money in place where it's growing. It's constantly growing. So when you're ready to use that money, you have a really good nest egg waiting for you. So I really want to point out some different types of terms and definitions that you need to be aware of when it comes to investing. So I mentioned cash flow. So basically, cash flow is the difference between the money that you have available at the beginning of a period and at the end of a period. So positive cash flow is meaning that you have the money that you have coming in is more than the money that you have going out. Negative cash flow is the opposite of that. So that means the money that's going out is more than the money you have coming in. Break-even cash flow means that you have just enough money to cover all of your expenses, nothing's left over. So net worth is the calculation of taking all of your assets and subtracting or taking out all of your liabilities. These are all of your debts, the things that your obligations, the things that you owe money on. So basically, there's two different types of assets. You have tangible assets and you have intangible assets. So basically, an asset is any item of economic or financial value that's owned by a person or company. So a tangible asset is something that you can actually touch, feel, hold, see. Things like stocks, real estate, gold. Intangible assets are things that you own that have a value, but they don't have an actual fixed physical nature. So intangible asset would be something like a copyright or something like that. Also, something I want to point out too when it comes to intangible assets is brand recognition, which is something people probably don't think about. That's a sort of intangible asset that you have. Like, for instance, if you see that little white check on some shoes, what brand is that? I don't even have to say the name. That's brand recognition. So that's a type of intangible asset. And also, a liability is some type of loan or some type of debt obligation, something that you have to pay. And return on investment, that's the key right there. That's what we really want to know about when it comes to investing. What's my return on this investment? How much money am I going to earn, or how much interest am I going to earn on this investment? How much is my investment going to appreciate in value? Those types of things. So return on investment is a performance measure, basically, that helps investors compare the return that's offered by one investment in relation to other investments as well. So return on investment is basically calculated by dividing your financial yield or your interest by the cost. And this is normally expressed in basically a percentage. It's normally expressed in a percentage format. So there's some steps that you need to take to prepare for investing. So step number one is to be consistent. So the first step to achieve financial success is to be consistent, have some type of consistent long-term financial goals in place, and a long-term financial investing plan in place as well. So you want to make sure that you're adopting some type of regular savings strategy. And savings basically is the backbone of a plan that helps you have the money that you need to invest on a regular basis. And then you want to think about when it comes to being consistent. You also want to make sure that, and I mentioned this, I think, during the first week of the first session that we did, I mentioned when it comes to obtaining financial freedom, this is something that takes time. And I mentioned time value of money. I'm going to talk about that again tonight. It takes time. It's something that's not going to happen like really fast or overnight. So you have to have a long-term view when you're thinking about investing, because this is for your future. But that doesn't mean that you shouldn't get involved right now. So success can come faster than you think. By learning, these simple investment lessons, you can begin making money while you sleep. And if you start investing early and you be consistent, then you're going to harness the power of compounding interest. And I just mentioned time value of money, which time value of money and compounding interest are synced together, related. That's how people build wealth, compounding interest. And I call it the key to wealth. So it's basically, compounding interest is basically when you earn interest on money that you're saving or investing, and then you earn additional interest on top of that. So it's basically, interest is doubling every time you earn it. So that means your money is growing at a greater rate over time. The second step in investing is to check yourself. Check your emotions. When we get emotional about different things, sometimes we tend to do things and make bad decisions. Our behavior may be different than normal when we are emotional. And this is actually true with investing too. So you want to make sure that you take the emotions out of it when you're investing. Negative emotions mostly affect people when it comes to things like greed and fear. And many people just chase money all the time. So they want more and more and more. But when they start to lose money, they start getting scared. They get depressed. And another emotional crutch for some people is to fall in love with a stock or a company or a piece of real estate. And even if they're seeing some signs that things aren't going right, they still won't let it go or try to look further into it. They get attached to it. And, people carry emotional baggage when they invest. And you can make bad decisions. So step number 2, check yourself, check your emotions. And the third step is control your emotions. You want to make sure that you don't have these different varying emotional responses to risk. And that's one of the very important things about investing. Is one of the first things that I always help my clients with is determine their risk tolerance. So you're trying to determine what your appetite is for risk. If you're somebody who doesn't want a lot of risk, then you understand that you may not earn high returns on those investments. If you're somebody who doesn't mind taking some risk, then you know that those investments that you look into, you're going to have probably some really good returns on those investments. And another thing I like to point out too when it comes to controlling your emotions is that, again, going back to what I said, you have to have a long-term view. You can't get into those get-rich-quick schemes because you can lose everything behind that. And some of it is illegal and you can go to jail. You've heard of things like Ponzi schemes. You've heard of bank fraud, of course. I know everybody's heard about what happened with Enron back in the day. These are just some examples of investment scams. And you don't want to let that happen to you. So make sure you're getting the knowledge like you are right now and making sure you're educated about the different types of financial decisions that you're making. And, when somebody approaches me with some type of investment idea, the first question I ask them is, well, do you invest in this yourself? If they say no, then I decline, walk away, and I go do my own research. It's okay to listen to other people's investment ideas, but you never want to let them convince you to get involved before you do your own due diligence. Always do your own due diligence. Do your own research first. You want to check out what they're claiming. Talk to qualified experts, people who are doing this for a living. This is their career. Read different types of books on investing. You can also do searches on the internet. There's so much information out there. The more you know about money, it matters. It helps you to be more successful and get to where you really want to be. So another important topic that I want to talk about concerning investing is diversification. And I know you've heard about this. So with diversification is basically, you've heard the phrase, don't put all your eggs in one basket. That's what diversification means. So it means that you're kind of basically spreading out your risk. You have a portfolio of different types of investments, and so you're spreading out your risk across those investments so that you won't lose all of your money at the same time. So there's different ways to diversify. So you can diversify between different asset classes, and you can diversify within different asset classes. So when I say between different asset classes, what I mean is that there's something called asset allocation. So that means that you have different types of investments in your portfolio. And I always like to recommend a mix of 70-30 or 80-20. So you want to make sure you have at least 70% common stocks or 80% common stocks. And then that other 30% or 20% are going to be a mix of different types of investments. So you can have a mixture of different types of bonds, commodities like gold and silver and those types of things. And so that is diversifying between asset classes. So when we talk about diversifying within asset classes, this means that you still have a really good asset allocation of the 70-30 or 80-20. But this time, you're going to have a different mix of different sizes of investments. Like, for instance, you may have heard the terms large cap stocks or mid cap or small cap stocks. And these are basically the sizes of the different companies of these stocks or investments. So basically, large cap stocks are the shares of the larger companies, of course. Mid cap are shares of medium-sized companies, and of course, small caps are shares of smaller companies. But you want to have a really good strategy in place. So just because small cap stocks are for small companies, you have to think, remember, we're having a long-term view. So you want to think ahead. So small companies are going to grow, right? So you want to make sure, a lot of people, just thinking back when Google first came out, it was considered to be a small company. And then it grew. And a lot of people who started out with that small company are now wealthy because that small company grew. So you never want to disregard small cap companies. You always want to have a good mix of those in your portfolio as well. And I also want to point something else out that's very, very important. You want to make sure that you avoid investments that have what's called a correlative relationship. And this means that there are investments that have strong connections to one another. So let me give you an example. If you only invest in Ford or Toyota, and you also invest in a company that makes steel, so say for instance, if something happens in the economy, in the industry, the auto industry takes a hit for some reason, then that means that the auto companies are not going to be making a lot of vehicles, right? So therefore, they're not going to be buying steel. So now you have money sitting in steel. You also have money sitting in Ford or Toyota. Neither of those are making money. So that's what I mean when I'm talking about those correlative relationships. So you see how much work you have to do. You have to do your due diligence. You really have to know and understand these things. So you want to make sure that your entire portfolio doesn't have those types of relationships. You want to have a different mix of different types of things in there. And so now I get to one of my favorite parts, which is where I explain to you or discuss some of my favorite types of investments, things that I like to recommend, because they're different types of investments that give you that diversification, and they help minimize your risk because it's spread out across your portfolio. So these types of investments are mutual funds, index funds, exchange traded funds. So basically, a mutual fund is like a managed investment that pools money from different investors to purchase different types of investments that align with that mutual fund's objectives. And one of the things about a mutual fund is that there is a manager of that mutual fund, and that manager actually owns that fund. So that means that if that manager owns that fund, then that means they have some skin in the game, with that fund. So they're going to make sure that that fund is performing well. So that's why a mutual fund is a really good investment to have. An index fund is a type of mutual fund. The portfolio is designed to track the components of a market index, and it basically gives investors increased diversification. It also helps you to have broad market exposure, and then the cost of the operating expenses on those are very low. Also with mutual funds, the operating expenses for those are very low. That's another reason why I like those. And you may have heard of different indexes, like you've heard of the S&P 500, you've heard of the NASDAQ 100, the Dow Jones Industrial Index. So those are index funds. And then we come to exchange traded funds. So these are what I call like a little basket of different types of investments. So you may have a mix of different types of commodities, indexes, and other areas. And it basically acts similar to an index fund, but it trades like a stock. So one of the things that I want to point out that's a difference between mutual funds and exchange traded funds is, so exchange traded funds trade like stocks. So if you can trade stocks throughout the day when the market is open. So during those 8 hours that the market is open, you can trade stocks all day long. The difference between that and the mutual fund is you can only trade a mutual fund one time a day. So that's the difference with the trading for those. And also with exchange traded funds, the fees are really low. The operating expenses are really low. And, mutual funds are investment vehicles, again, that are made up of a pool of money from different investors. Some common goals include income or capital gain. And I just want to talk about some different types of mutual funds so you have a good understanding of when it comes to determining your risk and determining what types of, because there's so many different types. There's so many different types of mutual funds. There's so many different types of exchange traded funds. So with mutual funds, you have some funds that are considered to be aggressive growth funds. And these are the funds where you're going to maximize your gains. You may leverage their assets by borrowing money and may trade in stock options. You have regular growth mutual funds. You have growth income funds. And these are ones that you have people who, so let me explain this first. So you have some investors who are interested in making income from their investments. You have some investors who are interested in letting their investments grow and letting the value of those investments increase. So when it comes to investors who want the income, so something like a growth income mutual fund would be those types of mutual funds that are paying dividends. So you're able to get dividend income from those mutual funds. And then they also are growing. So that's why they're called growth income funds. Then you have regular income mutual funds. You have what's called international funds. And I always recommend that you have some type of international investments in your portfolio. You always want to have some type of international investments in there. You have asset allocation mutual funds. You have what's called sector mutual funds, and this is basically when you invest in a specific sector of the market, like technology mutual funds that are going to purchase different types of tech stocks. So that's what that means. You have bond mutual funds, and these. So let me explain the difference between a stock and a bond. So a stock is what's considered to be equity. This is where companies issue shares of their companies because they're trying to raise money. So they're issuing you these shares of their company to earn money, and also giving you ownership in that company. So that's equity. Then you have debt investments, where you have like municipalities, cities, government, corporate. You have corporations, you have government entities who are getting these bonds because they need the money from these bonds to fund different programs or to repair roads and those types of things. So you have investors who loan money to the governments, to the corporations, and they get interest payments on the money that they loan out until they're paid back. So those are considered to be debt investments. So that's the difference between bonds and stocks. And then you have money market funds, which are basically mutual funds that invest solely in short-term debt instruments. And then you have equity mutual funds, which is basically a portfolio that consists of different types of stocks and may have a mix of different types of bonds as well. Again, you have different types of growth. If you want those different types of investments that are going to grow and accumulate value over time. You have different types of income investments. You have investments that are a combination of both growth and income. You have some investments that are considered to be what's called value investments. So these are when you're investing in large, remember I said that gave you the examples of the different sizes. So you have large cap and mid cap investments in these types of value related investments that may be undervalued, but then at some point things change in those companies, and then they start things change and their value drastically change. We've seen examples of this throughout the decade, over the past couple of decades, in different types of companies who were undervalued, and then things switched to changed around, and those companies came to the top, rose to the top, and their values increased. Then again, like I mentioned before, you have the small, medium, and large cap investments. You have the different sectors where you can purchase different types of, basically these are sectors or industry type investments like technology or health related, medical related. You have telecom, communications related, different types of things like that. You also have what's considered to be fixed income, or like I mentioned before, money market. And these are basically low risk funds. They earn much lower returns on average. They work as interest-bearing investments with reduced risk compared to equities. And then you have what's called balanced investments. And these are basically the ones that invest in the money market, bonds, preferred stock, and common stock. So when it comes to purchasing mutual funds, you have what's called a load. You may hear the word load. And this basically is like a sales charge, some type of sales charge or fee. So you have mutual funds that are considered to be front-end load, back-end load. You have some that are no load at all, and then you have some that are level load or low load. So a front-end load means that you are going to pay some type of sales fee or charge when you purchase the shares of that mutual fund. A back-end load means that you're going to pay some type of charge when you sell the shares, some shares from that mutual fund. A level load or low load means that you're going to pay some type of annual fee or charge for that mutual fund. And then a no load fund means that there's absolutely no charge at all. No sales charge at all on that mutual fund. So I mentioned also that I wanted to explain to you time value of money. So this is the last thing I wanted to bring up before we end. So time value of money is basically the concept that $1 earned today is worth more than if you earn $1 tomorrow or sometime in the future. And then if you think about it, so you have time and you have value. So these are very important concepts, because basically with time, that's saying that the earlier that you start saving or investing, then the more time your money has to grow, and you have a greater future value on that money. So that's why it's really important to even teach children about investing, helping them to start investing even at an early age. And I can remember being a little girl and having like my grandparents, great-grandparents, great aunts and uncles who would give me like a savings bond for my birthday or something like that. So teaching you at an early age how important it is to start investing and to start saving up. So another thing too that I want to point out, I mentioned this earlier with compounding interest, which is also a component of the time value of money. So compounding interest, again, is when you earn interest on money that you're saving or earning or investing. And then the next time you earn interest on top of what you previously had. So basically your interest is doubling every time you earn interest. So that means that your money is able to grow even more over time. So if you think of, just to give you an example of that, say if you invested $100 into an account or put into some type of savings account, and you earn like 3% on that $100, then that's interest that you've earned on that $100. And so that $100 is sitting there. You have 3%, which is $3. And then, so that's $103 that you earn. The next time you earn another $3, that's $106. So just think about how that money is growing. On that $100, you're earning interest every time. But then think about it this way as well. What if you continue to put $100 in that account every month? So not only are you earning interest on that $100, but you're also increasing, oh my gosh, the impact you have when you're continuing to put money in and it's continuing, you're earning interest on each one. Just think about $100, you're earning interest. Interest is building on that one $100 that you put in there. Is building, it's doubling every time. Then you put another $100 in there. Interest is doubling every time on that. So think about, you're consistently putting in $100 every month, and that's just an example. You don't put that $100 in just one time and just let it sit there. You put that $100 in every month, and then it's compounding. That interest is compounding on that money every time you earn interest. That's how your money grows, and it's able to grow more over time. So that's what I'm trying to really emphasize with the time value of money and those components of time and value, which is future value. So you're looking at the future, you're looking at the long-term view of things. So that's basically a basic overview of some things that I wanted to share with you about investing, and give you just some basic information about different types of terms and definitions that you want to be aware of when it comes to investing as well. And I want to see if anybody has any questions. Yes, consistency does matter. It does matter. You have to be consistent. If you want it to grow, you have to be consistent. You have to be consistent. Does anybody have any questions before we leave? Oh yeah, so that figuring out where to invest. Yeah, so that's why I said it takes work. You have to do your due diligence, because the first thing you have to determine is to determine your risk tolerance. You have to determine how much risk are you willing to take. And then once you determine that, that's going to help you determine the types of things you want to invest in. Remember, I just gave you a whole list of different types of mutual funds, exchange traded funds, the different types. You have the growth types, you have the income types, you have the value types, you have various different types. So once you determine the type of risk that you're willing to take, then you can determine which one of those you want to invest in. And then let me also mention this before we get off. There's different ways that you can invest. The stock market is not the only way you can invest your money. So most times people only hear about investing in the stock market or putting money in a 401k or an IRA. Those are not the only ways you can invest. Some people may not think of it this way, but a whole life insurance policy is a way to invest because those have what's called cash value on there. You can basically be your own bank because the money that you're paying into your policy, part of that is going into a cash value account. Is similar to a savings account, but you're earning a much higher interest, and you can also earn some dividends on that as well. You can also invest in different things like art. You can invest in real estate. There's also different types of like real estate mutual funds. You can invest in real estate. If you're not able to buy an actual brick and mortar building, you can invest in real estate investment trust. You can invest in real estate mutual funds, real estate exchange traded funds. And there's different types that are really well performing real estate investments as well. You can also invest in things like ships and boats. Just think about it. There's so many things that you can invest in. So it's not always just the stock market. So I just wanted to share that tidbit with you as well. So if we don't have any questions, that'll be all. That's everything I wanted to cover tonight. And this is our last session for this month. Thank you all for joining us this month for National Financial Literacy Month. I hope that you have enjoyed the information that I've been sharing every week this month. If you missed the previous weeks, you can go back to Brownstone's page. You can go back to Brownstone's page on Instagram and Facebook to see the recordings from the previous week. And if you are interested in some of the free templates that I mentioned that I have available, you can please feel free to email me. And thank you, Kim, for posting my contact information. You can also email me at contactus@zarisfinance.com, XARIS.finance.com. I have some free templates that you can use to help you create a budget, create a simple savings plan. I also have a template if you want to determine what your risk tolerance is. I have a worksheet that can help you do that. So if you want that, please email me and I'll send it to you. Alrighty, so if nobody has any question, that's it for tonight. Oh, so wait a minute. I do see one question. Hey, Ashley. Oh, so there's different ways that you can invest. There's different types of platforms. You can invest online. You can invest using apps. Of course, everybody has heard of the Robinhood app because of what happened with them a couple of months ago. So you have the Robinhood app. There's also, you may have heard of the online bank, Ally Bank, ALLY. So Ally also has an investing platform as well. They don't charge any fees. They don't charge any trading fees. You can use them to invest as well. E-Trade is another one that you can use to invest. There's so many different ways to invest. Oh, and let me mention this too. So now you can also, because there's the investments, the advancements in technology makes it so much easier to do things these days. So there's different websites that you can go to also invest in startup companies. Like if you want to be an angel investor, you can invest in startup companies. So there's different websites out there for that as well. You can go on Google and do a web search for angel investing, and it'll bring up some different platforms that are out there where you can invest in startups if that's something you're interested in. Thank you, Kim, for posting that email address. So my email address again is contactus@zarisfinance.com if you want to get those free templates that I mentioned. Alrighty, so thank you all for joining us tonight. Again, thank you for joining us this week and also the previous few weeks. You're welcome, Ashley. Thank you. And again, if you missed any of the previous segments, you can go back to Brownstone's page and watch those recordings. So I hope you all have a blessed night and blessed week. And thank you again for joining us. Good night.